You know, when a high-stakes divorce collides with a world of federal tax planning, things get complicated fast. And structuring a life insurance policy to secure a settlement, well, that's one of the most critical jobs an advisor can have. If you get it right, you preserve millions. But if you get it wrong, the consequences can be absolutely devastating. Today, we are diving deep into the key tool for getting this right, the Irrevocable Life Insurance Trust, or what we call the ILIT.
So why is this such a big deal? It all comes down to this number, 40%. That's the federal estate tax rate. And it can, completely unexpectedly, claw back a massive chunk of life insurance proceeds. We're talking about a multi-million-dollar benefit getting slashed by nearly half, all because of a few totally avoidable technical mistakes.
So this is the crucial question every single practitioner needs to be asking. How does a life insurance payout, one that was ordered by a court to protect a family, suddenly turn into a giant taxable event for the IRS? Well, the answer lies in a complex, tricky gauntlet of internal revenue code sections that you absolutely have to navigate perfectly.
And to get you through it, here's our roadmap for today. We're going to start with that estate tax gauntlet itself. Then we'll walk through the mechanics of funding the trust tax-free. We'll also cover the essential backup plan if things go wrong. And then we'll wrap it all up with a critical checklist to make sure your client's plan is absolutely bulletproof.
Okay, let's jump right into the primary threat, estate tax inclusion. To get through this, we have to understand two key code sections. First, IRC 2042, which is all about how the IRS defines ownership. And second, IRC 2035, which is that infamous 3-year lookback rule. Honestly, it's the way these two interact that trips up most plans.
So under IRS Section 2042, the IRS doesn't really care whose name is on the policy. What they care about is who holds the incidence of ownership, and Treasury Regulation 2020-42-1C2 defines this as the right to any of the policy's economic benefits. If the insured holds on to any of these powers, boom, the entire death benefit gets pulled right into their taxable estate.
And here it is. This is the single most dangerous phrase in the entire section. I want you to really focus on this. In conjunction with any other person. This is the tripwire. This is the little phrase that so many divorce decrees stumble over. It looks so harmless, but its implications are just massive.
Let's see this trap in action. A divorce decree might say something like, the insured spouse needs to get their ex's permission to change the beneficiary. Now, to a family law attorney, that looks like a restriction. But to the IRS, they see a retained power that's exercisable in conjunction with someone else. The policy facts, what's written in the insurance contract, will almost always trump the divorce decree. The bottom line is, the insured has to be stripped of all powers, completely.
And this brings us to an absolutely critical, non-negotiable rule. The insured spouse can never, ever serve as the trustee of the divorce ILIT. Now, you might know about Revenue Ruling 84-179, which creates a kind of safe harbor for an insured person acting as a trustee. But it doesn't apply here. Why? Because that safe harbor only works if the person didn't furnish the money for the policy. And in a divorce, the insured is always the one funding the premiums, so that safe harbor just goes right out the window.
All right, let's move on to the next major hurdle, the 3-year rule under IRC Section 2035. Even if you do a perfect job of stripping away all those incidents of ownership, if you do it by transferring an existing policy into an ILIT, a 3-year clock starts ticking. If the insured dies within that window, Section 2035 just yanks the entire death benefit right back into their taxable estate, as if the transfer never even happened.
So, how do you beat this thing? How do you get around the 3-year rule? Well, the answer comes from a landmark case, the estate of Headrick. The court basically said, look, if the ILIT is the original applicant and owner of a brand new policy from day one, then the insured never had any incidents of ownership to begin with. There was no transfer to trigger the rule, so Section 2035 just doesn't apply. This right here is the gold standard for setting these up.
Okay, so we've successfully dodged the estate tax bullet. That's huge. But now we have a new problem. We have to get money into the trust to pay the premiums. And this creates two new potential hurdles: gift tax on the money going in and income tax on the proceeds coming out.
First up, let's talk about gift tax. Every single premium payment is technically a gift to the trust. The way we solve this is with IRC Section 2516. It's a fantastic safe harbor that says any transfers made under a written divorce agreement are considered to be for full value, meaning they're not gifts, as long as the divorce happens within a 3-year window of that agreement. Problem solved.
But you know, it's never quite that simple, is it? What if the ILIT beneficiaries also include adult children?
Well, they aren't covered by Section 2516. This is where we need another tool in our toolkit: Crummey withdrawal powers. By giving the adult children a temporary right to withdraw their portion of the premium payment, we legally convert the gift from a future interest into a present interest. And that simple change makes the transfer eligible for the annual gift tax exclusion, which means no taxable gift.
And just when you thought you were safe, here comes the income tax trap. Generally, as we know, life insurance proceeds are income tax-free under Section 101, but the transfer for value rule can completely flip that on its head. If a policy is transferred for something of value, and believe me, releasing marital support claims is definitely valuable consideration, the death benefit suddenly becomes taxable ordinary income. This can be just as expensive as the estate tax.
Fortunately, the tax code throws us a lifeline here too. IRC Section 1041 says that transfers between spouses that happen because of a divorce are treated as non-taxable gifts, and crucially, the person receiving it gets the same basis as the person who transferred it. This carryover basis transaction is one of the specific exceptions to that nasty transfer for value rule. So thanks to Section 1041, the proceeds stay income tax-free.
So, we've talked a lot about how to get this right and exclude the policy from the estate. But what if something goes wrong? What if the insured dies within that 3-year window, or some incident of ownership was accidentally kept? We need a fail-safe. And that brings us to our backup plan, turning a taxable inclusion into a tax-neutral deduction using IRC Section 2053. So the goal is to deduct the life insurance payout as a claim against the estate. Simple enough, right? Wrong. There's a huge hurdle. Section 2053 says a claim is only deductible if it was for adequate consideration. But then you flip over to Section 2043b1, and it explicitly says that releasing marital rights does not count as adequate consideration. It's a statutory catch-22 designed to block the deduction. And here is the beautiful, elegant fix. Congress actually created IRC Section 2043b2 to solve this exact problem. It builds a bridge between the gift tax rules and the estate tax rules. It says that if a transfer meets that Section 2516 gift tax safe harbor we talked about earlier, it is automatically considered to be for adequate consideration for estate tax purposes too. It's a perfect statutory solution. And the end result is what we call a perfect wash. Here's how it works. Step 1. The $5 million of insurance proceeds gets included in the gross estate under Section 2042. But then Step 2, that exact same $5 million is deducted as a valid claim against the estate under Section 2053. The net impact on the taxable estate? Zero. It's a critical safety net that makes the whole plan incredibly robust.
Okay, let's bring this all home. We have walked through the entire gauntlet. So now, here's the practitioner's checklist, a summary of all the critical do's and don'ts that we've pulled from this technical deep dive. First, to kill that 3-year rule, the ILIT has to be the owner of any new policy right from day one. Second, you have to strip the insured of all incidents of ownership, no joint consent clauses, nothing. Third, the insured cannot be the trustee, period. Fourth, for funding, you use Section 2516 for the spousal benefit and Crummey powers for anyone else. And finally, make absolutely certain there is no reversionary interest that could ever bring that policy back to the insured.
This table really puts it all on one page for you. It lines up every major risk we talked about, from estate inclusion all the way to income tax, and matches it with the specific code section, the common way it gets triggered, and the precise strategy to shut it down. Think of this as your one-page roadmap to a tax-proof divorce ILIT. You know, when it comes right down to it, this is what we're talking about. Structuring one of these ILITs in a divorce really is a high-stakes tightrope walk over the Internal Revenue Code. A single misstep in the drafting or in the timing can cause a 40% loss of the entire settlement value. The level of precision you need here really can't be overstated. So, the final question is for you, the practitioner. With your client's multi-million-dollar settlement hanging in the balance, have you really navigated the tax code to build a true tax fortress? Or is there a hidden flaw somewhere in the structure that could make the whole thing a house of cards? Now's the time to go back and check your work.